Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Thursday. It's June 29th. Don't ask me where this month or this year is gone. I'm still thinking it's February. Folks, before we get into the nitty-gritty, make sure to like this channel, subscribe to our YouTube Wealth Press channel. Most importantly, subscribe to my Telegram channel. Go to rogerscott.com/Telegram. You'll get instant alerts, pictures of my cats and dogs, trade signals, a bunch of goodies in the Telegram channel, instant notification when these videos are out, and most importantly, we've temporarily, for the short term, opened up my VIP room to the public so you could get a second part of this video live with me today at 10 a.m. It's Thursday. Usually we go at noon. On Thursdays we go 10 a.m. and on Friday we go at 11 a.m. Follow the link below or above this video, whether you're watching on YouTube or Wealth Press channel, and or you're watching it on our website. Make sure to click the link and register or sign up or go for our VIP room. No cost. Now, let's get into all the juicy stuff, right? So it's 7:54 in the morning. The market's going to gear up to open in about an hour and 36 minutes. And as you could see today, oh boy, today, we've got GDP. We've got the biggest report of the quarter. We've got jobless claims. Before I get into the GDP, let me just take a look at the jobless claims. Now, just so you know, this number earlier in the year, last year, it was in the low 200s. Now it's coming up. It's stagnating near 260, 270,000. If it stays there, it'll be okay. But if this sucker starts moving towards 300,000, Mr. Jerome Squirrely Powell is going to have a very difficult time telling us that the job market is tight, because it's going to show signs of strain. So keep your eye on this report. It's going to come out in about 35 minutes or so. And if the number's 255, it's going to be a nothing burger. But if it starts going above 272, 280, 290, that means unemployment is creeping up. Now, let's talk about the biggest report of the quarter. And remember, the Feds are speaking. Powell repeats most Fed members see 2 more rate hikes this year. He's already said it. We kind of already know at least 2 rate hikes. Now let's look at it on an annual basis, GDP. On an annualized basis, they're looking at a growth of 1.4%. The expectations anywhere from 1.3 to 2. I'd love to see what this looks like. And personal consumption expenditure, still too early to speak here, is at 3.8. I believe it's going to come out fairly on the dot. I don't think there's going to be a major factor there. I'm more concerned with how the Fed interprets this, and the fact that they're saying there's going to be more rate hikes, and I'll get into the nitty-gritty today. But it looks like he's changing his tune to, we're going to pause, we're going to wait and see what happens, to, we need to raise rates, because inflation is sticky. Now, as we go through this, you need to keep your eye on the long bond. Now, this is not the long bond. This is an ETF, the 20-year plus Treasury ETF that tracks the long bond, and it's been consolidating near this channel, and I'm anticipating it to break out, because there's not going to be much news for the next 3 weeks on interest rates, and they've been fluctuating from the lows to the upper part of this channel, and I think that'll continue for the foreseeable future, because there's no major catalysts right now. So we have a channel, we have this consolidation channel, but we also have an ascending triangle within the channel. And since we're in the lower part of the channel, I predict this is going to break out and take us to the 106, maybe the 107 area, and then we'll see where we stand. If we can go to the 110, I would be selling bonds around that level. But right now, and remember something important. The worse the economic data looks, remember, this is an economy where we have an inflationary economy. So when Fed is saying negative things about the economy, it means good things for interest rates, because remember, the worse the economy gets, the lower they'll raise rates. In a typical environment, when the Fed says nasty things about the economy, it impacts everything negatively. But we're right now in an inflationary economy, so it's kind of one of those things where bad news can be good for bonds, good news can be bad for bonds. It's a wacky situation. And on top of that, bonds are inverse to interest rates. So it's very confusing. So when you hear them talking, the economy's weakening, the bond market's weakening, you got to say, well, is the bond market interest? It's confusing. So I'm just laying it out for you. I think interest rates are going to stay stable for the next couple of weeks. Especially if the GDP is negative. If the GDP is negative, it'll give more indication that the Fed will not do anything. So the worse the data, the better it is for the bond market, because the worse the economic data, the harder it will be for Fed to raise rates and say, well, things are better, we can raise rates. Inflation is sticky and it's not going away. And if they move too fast, it'll put us for sure in a recession. So it's a balancing act, but you got to watch the bond market. But either way, I expect the bond market to rally in the next couple of sessions, and possibly earlier. Now, you also have earnings on Nike. Now, Nike is a very important company because Nike is like a hub of consumer spending. It's a consumer discretionary company. If people don't have a lot of money, they cut things out like Nike. It's not like water or bread or cereal where you're going to get it whether you need it, whether you want it or not, because it's food. Nike is one of those things. You can pass up the Nikes for a quarter. And they have a big market cap and a big industrial production in China, and which has been slowing down. They're looking right now at 67 cents per share, which would put them 25% negative for a year. That's 25% and 12 point, a little bit higher year over year. I think they're going to beat these estimates or match these estimates. And looking at the chart, we'll take a quick look at Nike right now, just to give you some perspective of where we stand. Technically, Nike looks like it can go a little bit higher. So I think Nike actually kind of looks like a little bit like the bond market, right? Looks like it's consolidating around here, like an ascending triangle. Anyway, so I'm expecting a little high. There's no correlation between bonds and Nike. I'm just saying I'm expecting prices to rally. I like how they've been holding near the top here, and I think we'll break out. Again, there's no 100% certainty, but that's the case. Now, looking at the news, let's look at the news and then I'll look at the technicals and then we'll get into the nitty gritty. But three major benchmark ended the regular session mixed as investors weighted Federal Chair Jerome Powell's hawkish signals while embracing for another round of economic data, which is the GDP. U.S. Treasury yield dipped despite Powell's hawkish remarks. It'll be interesting to see what he says and how it impacts based on the GDP. Now, I hate to say I told you so, but I've been talking about cruise ships now for about a month. So Norwegian Cruise Liner added 7%, Carnival added 8%. They've been looking very strong. NVIDIA took a dump, and it looks like it can take a further dump. It looks like it might have topped out for the short-term period, as I'll show you what I'm talking about on NVIDIA. I think NVIDIA is going to head down here and then break and fill this gap. It may take a little while, but I think it will be doing it. I've said it since earnings came out, and I'm sticking to it. So if U.S. imposes new restrictions on export AIs, which I was big on yesterday, it's going to cause a major downdraft for the semiconductors. Now, interestingly, look at Mr. Squirrely, a.k.a. Mr. Powell. His lips were moving, therefore he was lying. Look at how he's changing his tune. I dare you to read this and then go back to what he said 3 months ago. It's like apples and oranges. During his appearance at the European Central Bank Forum in Portugal, Squirrely expressed his belief that further policy tightening was imminent. Really? Why didn't you say that 3 months ago? Nothing changed. The economy didn't get better, Powell. And hinted that the central bank would remain open to 2 consecutive interest rate hikes in upcoming months. Does that seem like a pause to you? No. Powell acknowledged the significant possibility of a recession. He wasn't talking about that, although he clarified it's not the most probable outcome. Boy, Powell's changing his tune because the market rallied. Now we're pricing in an 81, almost an 82% chance of a 0.25 basis point rate hike, and I think it's more likely than not going to happen. We've got earnings today and GDP. I already gave you the expectations. I think they're going to come in within reasonable levels. Pending home sales, I'm expecting good numbers because new home sales were surprisingly positive, and home builder residential real estate stocks are doing well, commercial or not. Make sure you make that separation. We've got initial jobless claims. I expect the number to be hopefully below 272,000. If it's 280, 290, that's going to give Powell another thing to worry about. And another reason not to raise rates, because you can't raise rates when unemployment is going up. That's a big problem. Unfortunately, unemployment is one of the last things to rise in an inflationary and a depressionary type of environment. Europe's central bank, Christine Lagarde, and Bank of England's Andrew Bailey acknowledged that there's still progress to be made in controlling elevated inflation, given the surprisingly resilient global economy and inflationary pressure. I agree. China closed lower as worries about sluggish economy in the world's second largest economy and absence of strong stimulus weighted on sentiment. And if COVID starts up again, we're toast. I mean, they're toast, but it's going to impact us. It's going to put another chunk. If unemployment rises, and if China gets really nasty with COVID, or their economy struggles, it's going to put a major weight on us. Real estate developers in China retreated on Thursday as investors waited further stimulus measures. Artificial intelligence lost ground, finally, expanding yesterday's losses as Wall Street Journal expressed their concern that U.S. may restrict export of AI chips to China, which is a theme that I'm seeing more and more, because remember, these chips, these AI chips are going to be military. They're going to be the next Terminators. They don't want China competing with U.S. Chips are going to be it's going to be like the arms talk in the next 10 years. In the same time, the Nikkei index closed slightly higher, rising for a second straight session as weaker yen boosted export-oriented stocks while strong retail sales lifted sentiment. Micron, we got to watch for Micron. We may get a little bit of a boost in chips because I was expecting a 1-2 punch, but they did better than expected. So we may get a little bit of a reprieve to the upside on chip stocks. Wells Fargo gained. The stress test from banks came out good, which is positive. Large banks are up. Academy Sporting Good, this is a good stock to trade. Up, they got a little rating, and Pfizer got downgraded. Today, all eyes are on Nike. Now, looking at the Dow Jones, notice the Dow Jones, as I predicted, it peaked out here. Algos had a little fun in the sun. Now it's trying to struggle and go up again. I think it'll pretend like it's moving above, but it's going to sag and come down. We have like a little head and shoulder pattern here. I think downside for the Dow Industrial, and I'll show you why. The two biggest players in the Dow are XLI, which is already above that level, and Basic Materials. Let me show you Basic Materials. XLB. And you could see that they're trying to break out. The problem is, if you look at momentum levels on Basic Materials, look at where we're at right now. It looks like it's huffing and puffing and coming down. Notice most of these, they're clusters. They do 2, 3, and then we pop down after we pop here. It looks like it's coming down. Now look at industrial. This is the 50-day moving average. Look at where we're in industrial. So the reason why I think that the Dow Jones doesn't have a lot of upside is because if you look at industrial stocks, the momentum levels are all the way up here. If you look at Basic Materials, they're coming down. Let's look at the 50-day on Basic Materials, because we were looking at both, might as well, right? Let's see if it's coming up or down. Still coming up a little bit. Maybe it looks like it peaked here. But again, industrial stocks not looking all that great. And also, you have overbought levels on consumer discretionary, information technology, communication services. The only thing that's really oversold is utilities. Utilities is really, really oversold right now. There may be some opportunities. But when utilities go up, they're defensive. Typically, most of these other sectors go down. So I'm expecting to see utilities and consumer staples start to rally at the expense of consumer discretionary, at the expense of infotech, at the expense of industrial and Basic Material stocks. I think that's what's going to happen next. I mean, look at the S&P 500. I don't think we're going to stay here very long. There's just no catalyst. So I think we're going to be coming back down. And I think tech, industrial, consumer stocks are going to be helping us go down there. I don't think this is going to break out above here because there's no major catalyst, and earnings are not even taking into account all the upside we've seen. They're just not that great. So there's a lot to worry about right now. Now, today's Thursday, and Thursday, I give you my top ETF and option pick, right? Well, let me tell you what my top ETF right now is. Let's look at these ETFs. Here are all the ETFs. Now, I know that communications looking really good, technology is looking good, but I believe these sectors are going to come up here a little bit more maybe, tease us into going long and break down, and this is going to be a double top. Same thing for here. Consumer discretionary, just depending on how Nike does. But be very, 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 very cautious. Financial looks very choppy. Healthcare looks very, very choppy. Basic Materials looks like it's near the upper end of the range. Let me just show you how that looks. XLB. Doesn't look, this rally here doesn't look like it's got more to go. I think this breakout is going to come down. So in my humble opinion, the best thing you could do right now is probably look for consumer staples or utilities. Now, utilities are really oversold right now. Matter of fact, if you look at utilities, let me show you where they are right now. See that? They look like they are about to come back up. Look at the 10-year. Look at where we're at right now. Look at the 6-month. They're all in that level. So I think utilities are going to be bouncing. And I also think, let's take a look at consumer staples. They've been really hit hard lately. Here. Yeah, you see that? On a 2-year, 5-year, they're down. So I'm expecting consumer staples and utilities to rally. In this case, I'd probably go with utilities, and I'd probably go with a longer-term option. I think this sucker is near the bottom, and I think it's going to rally in a bit. So I'm going to give you the utilities ETF. 50 days to go. If in the next 20 days it doesn't do anything, just roll it over. But I would go with the 64 strike price expiring 8/18. Now, what you may want to do is offset it with buy the 64 and sell the 67. Your cost is going to be like $1.50, and your upside is going to be about 4 points. Implied volatility is not high on these right now. Now, before I let you go, a few reminders. Make sure to like, subscribe to our channel. Most importantly, visit our VIP room today at 10 a.m. No cost. You should see the link above or below this video, whether you're watching it on the YouTube or our website. Most importantly, I've got something really big for you folks. Really big. Have you heard the news? I just filed a patent. Yes, a patent on a brand new trading software that I developed along with over 90 very, very happy beta testers. I think 92 or 93. It had like no refunds. It's amazing. And it's finally ready for the masses. It's a software that's so powerful that it can track where big money Wall Street is likely to flood into a stock at any time. It's amazing. And the track record, oh boy. 21 for 25 trades. Isn't that great? Pretty good, right? That's an 85% win rate. I'm so convinced that this software will be a game changer for the retail trader like you that I filed a patent for it. The big reveal is happening tomorrow, Friday. That's tomorrow, Friday, at 1:30 p.m. Eastern Time. Click the link below, RSVP, and do it fast. RSVP. You don't want to miss out. Patent pending tomorrow, Friday at 1:30 p.m. What's not to like? Follow the link, and I'll see you guys later. Make sure to like, subscribe, and post comments for me. I'll respond. Bye. Have a great, great Thursday, Friday Eve, as one of my friends calls it. Friday Eve. That's the ticket. Bye.